All right, guys, welcome back to video 7 out of 11 in the options education module. And we're going to be going over single leg strategies, which is actually a really nice break. We've actually learned a lot of fundamentals thus far, and this is just going to be kind of a review. So we're going to jump into the option chain on SPY again for sake of example. And we're going to be going over single leg strategies, right? So we've talked about buying calls, buying puts, and selling calls and selling puts, and the key differences between all of those strategies. So again, the long call, as we mentioned, is bullish in nature, with the long put being bearish in nature, right? That long call was a contract to buy shares, have the right to buy shares at that strike price, right? Which thus, we're going to want the shares to appreciate, right? So if we take a look at kind of the payoff structure, right? And we jump into this guy, we can actually visualize the returns, right? So for instance, if SPY is going to go up, we can see how the contract gets into profit. It's a little bit easier to visualize on mobile, but thus you can see bullish in nature. Same with the put, it's bearish in nature. So again, really kind of easy module. We've already actually covered a lot of this. So yeah, short put, that's essentially more of, what I do to get into stocks. It's sort of that paid limit order. You're getting income, which is the premium, on top of the potential to own those shares at that strike price if the strike is breached. And the wheel strategy is what I've kind of been hinting at, but if it wasn't explicitly mentioned, the wheel strategy is the fact of, you're shorting puts to start out. You're putting cash up front to potentially get that, allocation to those shares. When assigned, you then flip the script and you go to selling calls. And then once you're assigning those calls, you repeat and rinse again, and then go to short puts. It's just the wheel because it's a constant turn strategy wise, right? So not really much to say there. Short call. So remember that you're going to need collateral for each of these, right? So short put is the collateral of cash, and short call is the collateral of the stock. The break-even calculation, so we can actually go over that. We already kind of visualized this, but break-even is actually a huge point to make on more so, I would say short options is more so where I look at break-even, right? So for instance, if I was going to we'll sell the 39 DT put, right? So to calculate break even, it's already given to us, but to just kind of think about it, say I'm selling the 30 delta here. So, the 653, right? Break even is just saying, okay, I've received this premium and I'm going to pay for the stock at this strike, right? So all the calculation is it's the strike price minus the premium, right? So that gets you 646. So essentially you're still in profit until 646 with this contract, right? So this essentially lowers your average cost, right? Because say you get assigned at 650, it's going to say that you're at a $3 loss per share once you're assigned those shares. However, you have that premium that really has your break even there. And same thing is true for selling calls. Your break even for the strategy, or at least the opportunity cost of it. So let's say we go to, like a 24 delta, right? It's going to be the strike price added on to the premium. So again, the opportunity cost is for anything over 691.70 is where you're missing out on that capital gains because you're forced to sell at 688. So again, super easy module, super quick. But again, we've been going over all of this verbiage in the previous videos. So this is kind of just a quick little recap refresher. So hopefully this all makes sense, and we will see you in the next video.